Welcome to FarmCap. It is a non-bank lender structuring short-term private credit, and it is backed by Australian farmland. Now, they're solving the funding gaps that have been left by traditional banks and giving wholesale investors access to secured agricultural loans with double-digit returns. Let's talk to founder Jonathan Weinstock, who joins me now. And you brought a cap in as well, Jonathan.
Thanks, Juliette.
A little bit of merch.
I might put that on during our segment today, if that's okay.
All right. Well, this is a super niche area that you've carved out. Tell us why you went down this path.
It is very much a niche. And I must admit, around 2017, I was looking to invest wisely and safely myself. And I love private credit as an option, although I found it to be quite cluttered and I wanted to achieve some kind of premium return. I found a huge gap when talking to farmers who had bucket loads of equity in their land, that there was a lot of opportunities to lend to farmers and they weren't being looked after and terribly underbanked. So we built a business around helping farmers, providing money to fill these gaps, and as a result we're achieving premium returns and running a boutique specialist fund.
So tell us a little bit more about the fund and your team behind it.
Sure. Look, our fund launched earlier this year, but we've been writing loans on a deal-by-deal basis for quite some time, helping farmers all over the country, and like you said, achieving double-digit returns. Our investment is primarily first mortgage lending to a farmer, secured by agricultural real estate predominantly, and we also do some second mortgage high-yield investments to farmers as well.
All right, well, let's talk about what a typical loan looks like for FarmCap, and I guess some of the processes that you go through here for accessing applications.
Sure. Well, in terms of talking to farmers, we've created a national network, so we are bombarded by opportunities. We see 50 to 70 farmers seeking our help a month, so we get first pick of the deals. Thankfully, we're in a privileged position where we say no to at least 90% of incoming inquiries that don't make it to investment committee. And that in itself sets us apart. Then a very thorough due diligence process, getting to know warts and all the farm. You know, we pound the pavement, and I put on my hat, if you don't mind. I might put that on. And we head out to the farm. I guess over the last 7-8 years, I've been to hundreds of farms across the country, across all farming regions, and I've looked at over 2,000 transactions. So I don't profess to be a farmer, although I dare say my passion and interest, not only, look, we love helping farmers and we're actually solving a huge food security issue, which we'll get to in a moment, but very diligent, and we've got, as a result, a clean book and a clean history. Money goes out to farmers for typically 12 months, but it ranges from 6 to 24 months to plug that short-term gap, and the outcome is we help the farmer stay on the land, grow and prosper, and then end up back at mainstream and preserve value for their farm and their family.
Does the hat work? Does anyone stop you on the street and say, can you help me?
We get lots of requests. So for all your viewers, anyone who's interested in a hat, please reach out to me and I'll send one to you personally if you like. They are a massive hit,
yeah,
and we do hand them out and they're in demand.
All right, let's talk about the assessment and how it's different to a loan in, say, a different space, whether it be commercial property development or SMEs.
Sure. Look, at the end of the day, we're a real estate private credit fund. The difference and the niche that we've carved out is we specialise in agricultural real estate. Now, your watchers and listeners might not know, but agricultural real estate has been the top performing real estate sector. An AFR report came out the other week. In the last 20 years, it's outgrown residential, commercial and industrial property. It's a safe, secure real estate class, and we lend against agricultural real estate, backed by independent valuations by specialist agribusiness experts. And we're very thorough and diligent and take very conservative credit risk, up to maximum 60% loan against the land, and maybe a bit higher for a second mortgage. But at the end of the day, our current loan book average weighted LVR is around 55%, and currently actually returning a gross yield of 14%. So quite high.
So that is how you sort of work out the risk aspect, I guess, given that farming is so volatile. We were talking earlier to our earlier guest, you're dependent on weather patterns and the like.
Look, I guess we're in a privileged position where our loan is secured by agricultural real estate. Mm-hmm. So rain, hail or shine, breakfast will be served on everybody's tables tomorrow, and there are fluctuations in commodity prices, and the seasonality nature of farming is the exact reason why farmers, viable farmers, and there's 150,000 of them around Australia, will inevitably fall outside mainstream lending for one reason or another. So we're plugging those gaps. But interestingly, during dry times or wet times, farmland continues to rise. And the fundamental reason behind that is because farms produce food and fibre. Australia is the breadbasket of the world. We export 72% of what we produce, which represents 12% of total exports. And we produce top quality food with a global brand of being clean, green and traceable. And so I guess we sleep well at night, and I sleep well at night with my own money invested in most of these deals, that at the end of the day, our loans are secured by conservative lens against real estate. So irrespective of what happens for sheep prices this week or crop prices last month, we're not exposed to that. But over time, the underlying value of land is driven by providing food and fibre security, which is a very safe and robust asset class.
How many applicants, or what proportion do you typically end up lending to?
Well, look, at the moment we're lending to about half a dozen farms every month or so. And so, like I said before, we're seeing 50 to 70 deals a month come across our desk, and we're picky. We want to understand how we can help this farmer and make sure there's a clean way out to help them be better off. And so we say no to a lot.
Okay. Now, when you have those variables that we touched on and uncertainty surrounding, Trump's tariffs, weather, how are you then consistently achieving that 9.5% to 11% target per year?
Correct. Well, it's more double digits plus now.
Okay.
Look, we're not cheap, but we're a viable option outside the banks to fill a gap. So I guess we can consistently find farmers requiring help, and we're solving typically shorter term issues. We're not a long term funding solution. So a farmer that falls outside mainstream lending, time is of the essence with seasonality with farming, and so they're prepared to pay a premium. Now, I guess there's a lack of scarcity of capital in our sector and fewer players because it's so niche and boutique in what we do. We've got that deep sector industry expertise, and we do charge a premium, and that's how we can continue to keep our returns to investors quite high relative to risk, and particularly other real estate credit sectors, are typically fighting over deals, and so they might have to drop their price or take more risk. We're actually doing the opposite and stand out, and that's the benefit of being boutique and specialist.
What about when you see second mortgage loans and the risks associated with those? How do you sort of ascertain whether or not that's a worthy investment?
That's a great question, Gillette. Look, we look at the overall position of the farmer and what problem we're solving and how we can help them overcome a challenge, and then seek repayment in a timely manner. So I'll give you a great story, an example of a mango farm in the Northern Territory, 4 hours from Darwin. They've been farming for 35 years successfully, very profitable, and our mangoes are a delicious fruit and quite expensive, $3 to $5 normally per mango. And they had 2 bad seasons. One season there was a lap over with Queensland in the production cycle, so the prices dropped, and you could go to Paddy's markets in Sydney down the road and pick up a tray for $1. And so there was an unprofitable season, causing some gaps in working capital. And then the next year there was a freak weather event where, for whatever reason, the mangoes didn't grow for the first time. And so after 2 years, there was some cash holes in the business. The ATO started to hammer down, and they were under a lot of pressure. And so we spoke to their bank and said, hey, do you mind if we come and support this farmer to get through the next season at a very modest LVR? And we wrote them a cheque to save the farm and the business because the ATO was about to wind them up for over $1 million as a second mortgage at, again, a conservative LVR, typically max 60 to 65%, which is still arguably quite low. But, the return for investors on the risk and the lack of options to farmers, we can charge a premium. And so it's a balance between keeping the price, reasonable for the farmer, so they don't run into too many future challenges and can pay us back, and obtaining a nice, strong, secured return for our investor. So between 16 and 24%, we're achieving for up to 20% of our loans as second mortgages. But at the end of the day, we're taking LVR risk at a very modest LVR.
What are the overall goals for the fund and the size that you hope to potentially reach?
Look, good question. We actually don't have ambitions to be a $1 billion fund.
Okay.
We like staying boutique, premium and niche, and that sets us apart. I love having face-to-face conversations with our farmers, and we go and meet every farmer, and we keep it nimble with top quality, really smart people, and our staff, investment managers, also have family farming interests, interestingly, and we want to stay small and nimble, and I think we'll get to 100 million within the next 12 to 18 months quite comfortably, and we are seeing a lot of smart money starting to have a look under the hood and get to know us and realise that the quality of work's there, and we want to work with good quality investors who we can learn from and work with over the long term. We're not going anywhere, and we could grow from 100 to 300 million after that by writing bigger cheques or taking on slightly lower credit risk, and that's definitely something we'll consider in due course.
Might need some more merch if you get to that big.
We'll definitely get some more.
I've got some viewer questions for you, Jonathan. Roland asks, have you ever had any loans default, and what was the process for recouping those investor funds?
That's an excellent question. We have a clean book. We've had no recoveries to date, and so money has come back cleanly. So that's the answer, and the reason why is very thorough due diligence, knowing exactly what's going on. We don't do low doc loans, they're all full doc, which means we find out the financial history and the forecast, and we take a view on whether we can get our money back. And so far we haven't had an issue. Some investors are concerned about liquidity with farming, so it might take 3 to 6 months to sell a farm, whereas to sell a metropolitan property might sell quicker, and I guess we're capturing a liquidity premium for that extra time. And it should be noted, there is a farm debt mediation process should we need to step in and recover. And so all that means is post the Royal Banking Commission, the banks it became mandatory in most states, but not all states, to try and mediate with the farmer to give them more time. And so there's often times when a loan might mature and we can extend it and give them another 3 to 6 months or work with them. And so because of these extensions of, say, 6 to 12 months maximum, it gives them enough time to achieve an outcome. So we haven't had any issues, but we're well and truly on top of it to make sure at the end of the day, our responsibility is to our investors' money to get it back. But we also want to work with the farmer to ensure a good outcome.
All right, Andrew asks, is diversification across the portfolio important in terms of regions and types of agricultural commodities?
That's a good question. Look, coincidentally, we have a mix of farms and inquiries from all over, from the wheat belt WA to bananas in the top end, through to horticulture in Queensland and cattle country, through to broadacre and livestock all over. Look, about 30% of farms, between 30 and 40% of farms are located in each of Victoria, New South Wales and Queensland, and about 20% on the West Coast. But at times there might be pockets of opportunity where, say in South Australia last year, there was some dry periods, so you might get a few inquiries specifically. Or when dairy was struggling a couple of years ago and has now bounced back, or post a wet or dry event. Typically the banks take a year or two before they move their clients along, and we take on those clients. So it really depends. I mean, a good example was a dairy farm mid-North Coast that had recovered from floods from 2021 and was already back on their feet, but the bank took that long to do something about it, and so we've taken on that farm at a time when it was already profitable and viable again. So we do think diversification is important. We wouldn't want all our eggs in one basket, but we're open to opportunities and we assess each deal on its merits at the end of the day.
All right, final question from Stephanie. With so many private credit funds in the market, do you think banks will want to move back into this space?
Definitely not. It is too hard, it is too specialised, and old school banking is back. That's the feedback we get. So their 8th bank manager in 3 years who doesn't take their call is extremely frustrated. The farmer rings me on Boxing Day and I'm there on January the 2nd. So the chances of a bank being prepared to do that, particularly at the most underbanked level, which is sub $2 million and even sub $5 million level to these family farms, I don't think the banks have the skill capability or risk tolerance, and also have strict regulations now, more so around capital adequacy and servicing requirements. And out of those 150,000 viable farms, inevitably they will fall outside mainstream due to the seasonality nature of farming, and so that presents us opportunities and gaps to fill, and we can capitalise on those opportunities for our investors, and we love it. Put our money where our mouth is, and it's a great alternative. Talk about essential alternatives. This is providing essential food. It's fixed income. We pay monthly. There's great liquidity. The maximum loan's 12 to 24 months, so money comes back at these returns. It's a really strong, compelling offering, and I invite viewers to get to know us, look under the hood. Happy to share our diligence and our work and get comfortable, and that's the feedback we're getting from some really smart families who've seen all the products in the market and say, hey, Jono, we love what you're doing. Your work is solid. We're really pleased to get to know you.